So as I was saying earlier, just a moment ago, an avalanche of blue chip companies that reported financial results this morning. And I got to say, there were very few great numbers out there. Almost every company either missed on revenues, missed on earnings, guidance was so-so. Now, that said, these stocks haven't fallen apart, right? In fact, some of them opened lower and then turned higher. Now, here's the rub, folks. I want you to take a look at this because earnings, of course, they were bound to come down from last year. This is your trend line in the blue. Look at this parabolic move in the last year. This is crazy, right? So we knew we were going to come down. Obviously, we don't want them to come down to this point, but certainly as far as the trend is concerned, we knew earnings were going to be a lot lower, and I think to a degree some of that's already built into the market. Then there's the inflation question, right? Lower inflation, other signals, kind of keeping our hopes up, right, for a soft landing. Now, in a recent actions, Barclays is saying, okay, tactically they've actually turned neutral because they see risk. They say that risk have temporarily become Goldilocks. But here's the warning from them. As far as a soft landing is concerned, they believe it's been overstated. By the way, they're concerned about the labor market and the Federal Reserve. They say that the balance sheet runoff, which we don't really talk a lot about, that quantitative tightening, that's got a long way to go. And even with some of the big moves now, they see some profit taking in these emerging market assets also as we come out of the Chinese New Year. So they're saying, yeah, we'll pause for now, but nothing, the Goldilocks is going to be brief. So here's the thing. If we're still talking recession, we've got to look at the evidence that's mounting because it's hard to deny, particularly after this. This is the leading economic indicators. Came tumbling down big time last month. This is the peak back in February. We're down 1% month over month, down 7.4% year over year. Here's a fun fact. 6 prior times that this was down more than 7%, every single time the economy was in recession. By the way, the recession normally begins 11 months, go back to February, after the LEI has peaked. I want to bring in Bianco Research President Jim Bianco. Jim, so with all of this talk of soft landing and recession and trying to wait it to, you actually posted a really intriguing chart. Well, as always, you always post these great charts. But I didn't realize this. The percent of countries where the United States has higher inflation is still relatively high. 78%. Not long ago, we had higher inflation than every country, every developed country in the world. Are we getting ahead of our skis even talking the recession and deflation and all that stuff right now?
I think for right now we are. There's very little evidence that there is a recession. Yeah, there's some earnings disappointments and there's a problem in the housing market. And some tech companies are laying people off, although if you look at the sheer number of people they hired in the last 3 years, it's not even beginning to reverse that. But most of all, I think most companies are doing okay right now. Not great, but okay.
Right.
And the market, let's remember, Charles, what the market cares about. The market cares about interest rates. It wants the Fed to pivot. It's a kind of this obsession that it has. And strong data, remember, that's the old, good news is bad news, might mean, or okay economy might mean that the Fed isn't seeing an urgency to cut interest rates. So the market kind of goes back and forth here. Is it bad that the Fed doesn't have signs to cut rates, or is it good that the economy's not falling apart? It can't quite make up its mind which way it wants to go. Right now, it seems to want to say it's good that things aren't falling apart. It'll worry about, interest rates later.
So it's one thing that a lot of folks have been hyperventilating about, and it's the money supply, that it's crashing and that it's never crashed like this before. Again, leave it to you to come up with one of these great charts. So we've got it up here. And yeah, money supply, anyone can see this is historic. I mean, look at this going back to over 100 years. And we hadn't seen anything like it in a small window. But if you go back further, 69, 49, 39, 1929, in those areas, we have seen this before. So taking it all into account, I mean, is this enough to say, okay, the Federal Reserve will tap the brakes?
No, it's not. And I'll tell you why. Because if you go back into the first 50 years of that chart, if you measured bank deposits, that was money. There was no other form of money. Today, I know we got crypto, but more importantly, for a lot of us, we consider unrealized gains, maybe there are losses now, but unrealized gains, unrealized home equity, maybe even the trade-in value of our car, or other things as part of money that I could convert that into something I could spend. So money becomes a much bigger thing than just M2, which is what you're looking at. That's a subset of money. That's down, but other forms of money are not. So it's very difficult for us to say, is money contracting or isn't it contracting? One measure of it is, but it's not a complete measure. That's why I think that the relationship between M2 and inflation over the last 30 years has been very small, and that just because it's coming down, yeah, inflation's coming down. It's gone from 9 to 6, but doesn't mean that inflation is going to go to zero because money supply is at zero.
Right. Great points, Jim. Always appreciate it. We're always learning something from you. Thank you very much, my friend.
Thank you.
All right, folks. So I want to bring a Money Map Press.